Welcome to The Explainer. Look, if you're an accounting expert, an auditor, or a finance leader, you are absolutely in the right place today because we are unpacking the most significant update to financial statement presentation in decades. We're going to do a high-level, paragraph-by-paragraph comparative analysis to understand exactly how IFRS 18 replaces IAS 1. The era of flexible financial statements is ending, and a new era of strict, globally comparable structures is beginning. Let's get right to it.
Okay, let's quickly hit our agenda. 1. Foundations and general requirements. 2. Performance and aggregation rules. 3. Financial position and equity. 4. Notes, disclosures, and NPMs. And finally, 5. Summary and transition rules.
All right, Section 1, Foundations and General Requirements.
Now, what's really fascinating here is how IFRS 18 specifically redefines the fundamental purpose of your reports. Under IAS 1, we basically just had general presentation guidelines. But now, IFRS 18, specifically paragraphs 16 and 17, assigns strict, distinct roles. The primary financial statements are explicitly tasked with providing a useful, structured summary to give users a clear, understandable overview. The notes, on the other hand, they are now formally defined as the engine for disaggregation. This isn't just semantics, guys. It fundamentally changes what goes on the face of the financials versus what gets buried in the back.
Now here's a bit of relief for your reporting templates. The complete set of financial statements defined in IAS 1, paragraph 10, your balance sheet, P&L, cash flows, statement of changes in equity, and the notes, that whole set is retained exactly the same in IFRS 18, paragraph 10. Same goes for standard reporting frequency and identification requirements. But take a look at the caveat here. General features like fair presentation, going concern, and accrual basis, they haven't vanished. They were just neatly relocated from IAS 1 over to IAS 8.
Moving right along to Section 2, Performance and Aggregation Rules. Okay, the absolutely crucial point here is this overarching principle from paragraph 41. IFRS 1 touched on materiality and aggregation, sure, but very briefly. IFRS 18 expands this into a dedicated, highly rigorous section. It mandates that every single line item must now be sorted strictly by shared or dissimilar characteristics, meaning you can no longer just lump dissimilar items into a bucket labeled Other Expenses if it obscures material information. The standard demands that aggregation in the primary statements and disaggregation in the notes follow this strict logic. Plus, it really tightens up the rules around when you're actually permitted to offset items.
You are definitely going to want to memorize this list. Paragraph 47 completely restructures the statement of profit or loss. You are now forced to classify literally all income and expenses into one of these 5 mandatory categories: operating, investing, financing, income taxes, and discontinued operations. There's no wiggle room here. Opting out is just not an option. And this brilliantly illustrates the real transition we're dealing with. Under IAS 1, you had this highly flexible, almost choose-your-own-adventure approach to the P&L. Entities presented wildly different subtotals, which honestly made peer-to-peer comparison a total nightmare for investors. Well, IFRS 18 ends that flexibility. By enforcing those 5 categories, it mandates new, rigid subtotals, most notably, a standardized operating profit or loss. We are officially moving from maximum flexibility to a highly rigid, globally comparable structure. Now, you can take a breather here, because amidst all these massive changes, the treatment of other comprehensive income, or OCI, remains essentially a safe haven. IAS 1 gave you the choice of presenting a single statement of profit or loss and OCI, or splitting them into 2 separate statements. It also required grouping items by whether they'd eventually be recycled into profit or loss. Good news, IFRS 18 entirely retains the structure and choice. So if your current OCI presentation works, it's very likely going to survive this transition completely intact. All right, let's pivot to Section 3, Financial Position and Equity.
Confirming some more great news for your transition planning. The criteria for classifying assets and liabilities as current or non-current is virtually identical. You might remember the recently, and heavily debated, amendments to IAS 1 regarding an entity's right to defer settlement of a liability for at least 12 months, especially when covenants are involved. Well, those specific rules were carried over word for word into IFRS 18, paragraph 101.
Similarly, the statement of changes in equity remains largely untouched. IFRS 18, paragraph 107 basically mirrors IAS 1, paragraph 106. You're still going to show total comprehensive income, the effects of retrospective application or restatement, and transactions with owners in their capacity as owners, like dividends or equity contributions.
The level of flexibility and the core requirements here have neither significantly increased nor decreased.
Next up, Section 4. Notes, Disclosures, and MPMs. This is a big one.
So pay close attention to this entirely new concept introduced in paragraph 117. What you previously and probably fondly called non-GAAP measures or alternative performance measures, think adjusted EBITDA or core operating profit, they are now formally defined by the standard as management-defined performance measures or MPMs. Basically, if you use a subtotal of income and expenses in your press releases or investor decks to communicate management's view of performance, congratulations, it is now officially an MPM.
And here is exactly why that new definition matters so much. Paragraph 123 literally drags these previously outside measures right into the audited financial statements. You must now disclose your NPMs in a dedicated note. You have to provide strict, completely transparent reconciliations between your NPM and the most directly comparable IFRS subtotal. Plus, you have to explain why the measure is actually useful, detail exactly how it's calculated, and justify any changes made from prior periods. The days of just tossing adjusted figures into a press release without rigorous audited backing in the financials, those days are over.
This officially transforms the notes from the ground up. Under IAS 1, paragraph 113, you were basically just asked to present notes in a systematic manner, which usually meant following the order of the primary statements. IFRS 18 turns the notes into a strictly governed engine. It dictates that notes must explicitly disaggregate those primary line items based on those characteristics we discussed earlier. It maintains strict capital disclosure requirements, all while formally integrating these new, heavily scrutinized MPM disclosures. Let's wrap things up with Section 5, Summary and Transition Rules.
Here is the ultimate screenshot-worthy summary table mapping out this massive shift. For the P&L, we're moving from flexible subtotals straight into 5 mandatory categories, enforcing a very strict structure. For aggregation, we transition from brief, loose guidance to dedicated principles requiring characteristic-based sorting. And for performance measures, we are pulling non-GAAP metrics from outside the financials straight into the notes, mandating audited reconciliations. Finally, let's talk about the transition timeline. According to paragraph C1, IFRS 18 is mandatory for annual reporting periods beginning on or after January 1, 2027. Early application is permitted, sure, but please don't let 2027 lull you into a false sense of security. Paragraph C3 requires rigorous retrospective application. What does that mean? It means when you publish your 2027 financials, your 2026 comparative periods must be completely restated and reconciled to the new IFRS 18 structures. So, the data collection and mapping for this transition, it really needs to begin well in advance.
I'm going to leave you with this final thought. The shift from IAS 1 to IFRS 18 is not just another compliance exercise. It fundamentally changes how your company's performance is communicated to the market. So ask yourself, is your finance team actually ready to map existing non-GAAP measures to the stringent new audited MPM requirements? The heavy lifting starts right now. Thanks so much for joining this explainer, and good luck with your transition mapping.